Hi, my name is Colin, Assistant Manager at IFA's Research and Portfolio Management team. And in this episode, I'll be talking about China. We have previously upgraded our outlook on China equities in June, but as we all know now, the bad news keep coming out from China, and that just keeps getting worse. And there also has been a sharp sell-off in Chinese equities since our last update. So, what has been happening in China? So the property crisis has worsened, with home buyers across China threatening to boycott mortgage payments. The COVID-19 situation has also worsened, with flare-ups in cases across the country. The economic situation has also worsened because China has signaled that it may miss its annual GDP growth target of 5.5%. So is it perhaps unsurprising that the MSCI China Index has corrected sharply since the strong rebound in June and on a year-to-date basis? Chinese equities have delivered losses of about 16.5%, and the market still remains one of the worst performing equity markets despite under our coverage. But despite all this bad news coming out from China, we still like China, and over the next few slides I'll be explaining some of the reasons why we remain optimistic. The first reason is because China's policy backdrop remains accommodative relative to the developed world. They have been ramping up efforts throughout 2020 to revive its economy using policy tools such as interest rate cuts, issuance of special bonds for infrastructure, investment, tax rebates, and also a cut in vehicle taxes. And more recently, the PBOC has responded to weaker economic data with surprise interest rate cuts, and more cuts could be coming given that China's recovery remains fragile. In terms of fiscal policy, the government has also been doubling down on its infrastructure push, including the setting up of a state investment fund to spur infrastructure spending. More support is likely on the way, as the authorities are considering bringing forward the local government special bonds quota for 2023 to fourth quarter of this year, and in an effort to accelerate infrastructure spending. And there was also fresh support for the property sector, as the government has instructed a state-owned company to provide guarantees to a number of private property developers issuing bonds. So this will help the property sector as well as the property developer to refinance their debt. China's verbal intervention has also continued. The Chinese government has been saying a lot of things this year that indicates that their intention is to support the economy moving forward. This has continued with Premier Li Keqiang saying in the recent meeting that the government will step up policy support, and he has also urged local officials to bolster their pro-growth measures. So in both words as well as action, the Chinese government is serious about stabilizing its economy. And at this point, we do think that it is important to emphasize that China is easing its monetary policy at a time when major central banks are tightening. And this has been made possible because of comparatively lower inflation in China, which is currently at 2.7% year-on-year, as compared to the US, where inflation is at a much higher 8.5%. And of course, China is now unlikely to hit its 5.5% growth target this year, but this does not mean that China is abandoning economic growth altogether. China is in fact expected to grow by 3.5% this year, which is considered bad by China's own standard, but 3.5% is still a level that most countries will be happy with. So by comparison, the US is only expected to grow by 1.7% this year. Zero COVID, that's of course a huge headache, not just for investors, but also for the people staying in China because of the sudden lockdowns and the disruption to their daily lives. But there are also still reasons to be optimistic on this front. So firstly, the scale of the recent outbreak is less severe this time round. If you look at the chart on the left, yes, there has been an uptick in cases, but compared to the tens of thousands of cases that were recorded in April, this current outbreak is just a small fraction. And despite the government's official message that they will not change their zero COVID policy, China has actually been adjusting and softening their stance since 2021. Zero COVID was initially a strict approach that pursues zero infections, but China has quietly shifted to what they now call dynamic zero, which is a less restrictive approach that aims to contain outbreaks in the shortest time possible. In recent times, they have also taken steps to ease their border restrictions and quarantine requirements. And the government has also been highlighting the need to achieve greater balance between economic growth as well as COVID measures. On the ground, there are also signs that China is indeed becoming more pragmatic in their COVID policy. This was evident in Shanghai, where the government has implemented more targeted control measures to bring down the recent flare-up in cases. You may have read about the chaos that took place at the IKEA store in Shanghai after it was being locked down because of a close contact that visited the store. Shoppers were screaming to get out of the building before the doors were locked. Yes, it is that extreme, but I don't think it is a representative of what is happening on the ground. Because if you look at the Shanghai metro passenger volumes, you will see that public transport is in fact still up and running, and that movements in Shanghai has not been significantly restricted. We are not saying that there will be no lockdowns. There will be, especially if there are flare-ups in cases. But a crucial difference this time round is that China's COVID stance has become more pragmatic, and future lockdowns are likely to be more targeted, and we expect this to be the case moving forward. On top of that, we believe investors may have been too pessimistic on earnings outlook for Chinese companies. If you look at the earnings estimates for MSCI China Index in 2022, it has already been slashed significantly this year. This is in stark contrast to the US equity market, where earnings estimates for the S&P 500 index have seen upwards revision this year despite mounting economic risks. And the good news is that the earnings of Chinese companies have been relatively resilient so far despite the lockdowns in China, with several index heavyweights such as the Alibaba, JD, Meituan beating earnings expectations. And also the worst of the regulatory crackdown on China's tech sector is also behind us, with regulators hinting over the past few months that they may ease their regulation on the tech sector. And there also has been more positive news flow on the delisting front as well, because the US and China have come to a preliminary agreement that will allow Chinese companies to remain listed in the US. And at this point in time, there is just extreme pessimism towards Chinese equities. Investors are also struggling to look beyond China's headwind when they think about China. All they can think about is risks, and some investors just want nothing to do with China anymore. So with this kind of extreme pessimism, we believe this is a sign that the market is not too far from the bottom. Valuations for Chinese equities are also undemanding. The MSCI China Index is in fact trading at a PE ratio of about 8.9 times based on 2024 estimated earnings. And applying our fair PE ratio of 14.5 times, we project a 63% upside potential for Chinese equities over the next 2 years. So putting everything all together, we believe that there are compelling reasons to be optimistic on Chinese equities. A lot of negative have already been priced into the markets, and China is now easing on all fronts. Not just monetary policy, but also its fiscal policy, property market, COVID, as well as tech regulations, which means that all the factors that have caused a sharp sell-off in Chinese equities over the past year are now starting to reverse. And moving ahead, we do see room for Chinese equities to outperform as it heads towards the end of 2022. So in terms of recommended products, investors can consider the JP Morgan China Equity Fund or the iShares Core MSCI China ETF. For a pure play exposure to China's tech sector, investors can consider the iShares Hang Seng Tech ETF. In the long run, it's hard to ignore China. Like it or not, China is of great significance to the global economy. It is the second largest economy to the world, it has the largest consumer market, and it also is the largest exporter of goods in the world. But despite that, China remains underrepresented in our portfolios, with Chinese equities constituting only about 3.5% of the MSCI AC World Index. So the recent sell-off in Chinese equities has in fact created an attractive entry point for a market that will become an important part of the global equity benchmark over the coming decades. And with the ongoing US-China decoupling, investors will likely need deliberate diversification across countries, and this warrants a standalone allocation to Chinese equities. Investing in China is a long-term endeavor. There are obviously a lot of things to worry about when it comes to China, but investors who can look beyond the short-term headwinds will be able to access long-term growth in China as it transits to an innovative economy. And with that, I come to the end of my update today. Thanks for watching, and see you again.